Hello and welcome to the Business Standard Morning Show. I'm Ishan Gera and here are the stories for the day. When Nirmala Sitharaman took over as the country's finance minister, little did she know that she would have to steer the economy through one of its worst phases. One after another, three waves of COVID-19 ravaged the country over the next 2 years. And now a war in Eastern Europe has set the commodity prices on the boil. The finance minister can be forgiven for thinking that she cannot seem to catch a break. In a freewheeling interview with Business Standard, the FM spoke on an array of topics including why she sees better days ahead and why spending on capital assets may be a better bet than sector-specific fiscal steps.
I think the growth momentum now which we've attained will continue. And I'm fairly confident, and I'm not just talking, fairly confident that Indian citizens have actually understood that it is for them together with the state governments and central government to ramp up the way in which we are going to recover. So it is not governments alone, it's the people of the country who are really putting their best foot forward. And therefore I can confidently say that we'll be on that kind of a growing trajectory.
Speaking to Business Standards, Shrimmi Chaudhary and Arup Roy Chaudhary, Union Finance Minister Nirmala Sitharaman on Friday showed confidence in the robustness of the Indian economy. This was despite the upheaval caused by the pandemic, which the FM said even forced the government to consider presenting 5 mini budgets in 2020. She said that the government has turned to a public capital expenditure program to revive demand during this tough period. The FM said that spending on capital assets was chosen since the government had adopted that route for economic revival during the pandemic too. Capital expenditure is the money spent by the government on the development of buildings, health facilities, education, and other infrastructure. The centre's capex outlay is estimated at 7.5 trillion rupees in FY23. According to the FM, of that, 1 trillion rupees will go to states as a long-term, interest-free loan for their capex needs. In comparison, the government's capital expenditure through the budget was 3.35 trillion rupees in 2019-20. The entire 1 trillion rupees could be given to states in the July-September quarter itself. The FM said that the rules for distributing the loan had been framed. Many states were ready as they had already submitted their projects, both greenfield and brownfield, for evaluation. Sitharaman was confident that the amount would be picked up by states before the end of the second quarter. The FM also tried to assuage concerns around the fiscal deficit, saying that despite continuing external headwinds, it was under control.
Well, I think the revenue buoyancy that I've been talking about gives me a little bit of a comfort. But yet, the challenges which are external, as I said, are not in my hands. We are being absolutely nimble, I would think, and I'm not self-certified, in sourcing materials from places which can help us in terms of cutting down on the costs. So that exercise will go on. Many states have been absolutely conscious of where they have to cut down, where they have to not cut down in the interest of the larger picture. And the synergy between the states and centre, irrespective of all that we may say, absolute. That's why I use the word hand-holding. Holding each other's hand, centre and states with each other. During these years, will continue.
Speaking on soaring inflation, which is giving a tough time to policymakers, FM Sitharaman said that it is still nowhere close to what other countries are seeing. But at the same time, she conceded that it was burdensome for people, especially those with low income. From 3.4% in FY19, retail inflation showed a continuous rise to 4.8% in FY20 and 6.2% in FY21, before easing moderately to 5.5% in FY22. Headline retail inflation for May 2022 cooled down from the 8-year high of the previous month to settle at 7.04%. The Reserve Bank of India expects inflation to average above the 6% mark till the October-December quarter. The FM also said that the bank privatization plans were almost ready and the government would bring amendments to the Banking Regulation Act soon. She added that while the centre would continue owning some banks, in the banks which it does decide to exit, it could do so completely. While there has been no official confirmation from the government, Central Bank of India and Indian Overseas Bank are said to be the candidates for privatization. On the compensation to states after the recent GST Council meeting, the FM said that the government was conscious of COVID-affected revenue growth, and those 2 years cannot be taken to measure any kind of growth percentage. But she said that the government is yet to take a call on rate rejig. Cost overruns and delays are perennial problems that hamper infrastructure projects in India. With its ambitious capex plans hanging in the balance, will the government be able to overcome such challenges and spur the economy on?
सब अच्छी दिख रही हैं यार, कौन सी खरीदूं?
ये तो वही बात हुई, 4000 शेयर्स लिस्टेड है, कौन सा लूं?
वो तो सबसे आसान है।
तुझे 5 पैसा नहीं पता?
अब तो सबको पता है। 5 पैसा पर है 4000 स्टॉक्स की रिसर्च, टेक्निकल टूल्स और इन्वेस्टमेंट आइडियाज। डाउनलोड 5 पैसा नाउ।
अब तो सबको पता है, investing made easy and rewarding with 5 paisa. Investments in securities market are subject to market risks. Read all the related documents carefully before investing.
In the interview, Finance Minister Sitharaman called her experience as the chairperson of GST Council humbling. After the initial teething troubles, goods and services tax completed 5 years last week. Our next report offers a peek into the journey so far.
In his budget speech of 2006-07, the then Finance Minister P. Chidambaram had floated the idea of moving towards the Goods and Services Tax or GST regime, and the next decade was spent in thrashing out his final contours and mustering the courage to usher in the reform in indirect taxation. Amid much fanfare, the GST was finally rolled out on the midnight of 1st of July 2017 by Prime Minister Narendra Modi. The nationwide reform subsumed 17 large taxes and 13 cesses. And after initial hiccups and tepid collection, the GST revenue has picked up pace over the last 2 years. The average monthly gross GST collection for the first quarter of FY23 has been Rs 1.51 trillion against Rs 1.1 trillion in the first quarter of the last fiscal, showing an increase of 37%. Economic recovery from the pandemic, high inflation, anti-evasion measures, especially against fake billers, and gradual improvement in compliance have helped. But as Business Standards A.K. Bhattacharya pointed out, the total GST collections in FY22 were about 6.26% of GDP compared to 6.22% in FY19, which was both a pre-COVID year and the first full year after the new tax was rolled out. The growth is nowhere near what was expected.
As far as whether GST has been able to fulfill the basic objectives which it had been introduced for, I would say yes. With multiple indirect taxes, there were multiple issues as well, including the cascading effect of taxes, the multiple compliances that one was required to do, the multiple authorities that companies were being made to deal with. So all those issues have now completely sort of eradicated. And I think there are 3-4 things which the government should really focus on going forward. One is to bring in oil and natural gas within the ambit of GST. Secondly, I think they should also make the GST appellate tribunal on fast track. The government should seriously look at is to implement a policy guideline for the functioning of various intelligence agencies and the process that they should follow and what are the real powers of these officers so that there is minimum harassment for genuine taxpayers.
A common complaint is also that the GST system is yet to stabilize even after 5 years because of the rate structure and constant tweaks. It still suffers from bottlenecks. But at the same time, GST is said to be one of the finest examples of cooperative federalism, as the centre and states come together in the GST Council, and almost all decisions are taken with consensus in the larger interest of the country and its people. But some states are unhappy as they stare at a stoppage of compensation for revenue loss from the cess fund due to GST implementation.
I think so far the GST has worked out, I think, reasonably well. There were a lot of glitches, but that's not unusual. Almost every country which has implemented universal VAT, which the GST is, it's taken between 8 to 10 years for the system to stabilize. There will be tweaking that will be required simply because of the multiple rates, the very large number of exemptions. Correcting all of this is both a political issue as well as an economic issue. And I think on the economic side, things are falling into place, but the political side, of course, will continue as governments change in different states. New views are put forward on the structure of the GST.
Businesses say the government should work further on simplifying the tax system to boost the ease of doing business. Taxpayers have struggled with the demands of GST compliance and return filing, although this burden has been progressively reduced.
The few things that stand out has been a very good technology platform by the government, which has been welcomed by industry. Second, what has stood out is a collaborative and consultative measure from the government in terms of interacting and issuing clarifications on contentious matters. In terms of what next, industry expects 3 changes or 3 aspects, I would say: unlocking of working capital, ease of doing business related changes, and input tax credit reforms. Unlocking of working capital is basically saying that the law does allow refunds for exporters and inverted duty structure. But if I'm a domestic business with capital intensive or a long-term gestation period to make a profit, I'm stuck with the credits. There are a bunch of restrictions that were grandfathered from the earlier pre-GST law in terms of infrastructure, in terms of personal consumption, but the interpretation gets a little gray when you apply it to hospitality and tourism industry, for example. There is a hope that when we pause and reflect and look forward, is it time ripe to get away with all of the restrictions such that we have a completely seamless GST credit chain?
The government has been proactive in addressing any major pain points, but there is still a long way to go before GST can achieve its full potential and become a truly good and simple tax as envisaged. Meanwhile, the immediate priority of the government will be tax rate rationalization, as the centre and states need higher revenues, and lesser slabs would mean a simplified tax regime.
क्या हाल?
मत पूछ यार, फिर से स्टॉक्स में फंस गया।
तो स्टॉक्स के साथ बॉन्ड्स, इंश्योरेंस, गोल्ड में बैलेंस कर।
इसमें बहुत तामझाम है।
तुझे 5 पैसा नहीं पता?
अब तो सबको पता है। 5 पैसा है ऑल इन वन अकाउंट। डाउनलोड 5 पैसा नाउ।
अब तो सबको पता है। Investing made easy and rewarding with 5 paisa. Investments in securities market are subject to market risks. Read all the related documents carefully before investing.
Revenue Secretary Tarun Bajaj told Business Standard last week that the recent tweaks in the GST regime might add 15,000 crore rupees to the government exchequer every year. Meanwhile, in another move to boost revenue, the government imposed windfall tax on gains made by domestic refiners. Indexed heavyweight RIL dropped over 7%, while other oil upstream and exploration linked stocks slumped up to 15%. But should you buy these stocks on the dips? Let us find out in our next report.
Last Friday, the government took investors by surprise. It announced levy of export duty on petrol, diesel, and aviation turbine fuel. Besides taxing exports, the government also announced the imposition of windfall tax on gains made by domestic refineries. A cess of 23,250 rupees per ton on domestic crude production was also imposed. The move clipped wings of upstream oil companies, with shares of Reliance Industries declining over 7%. Other related stocks fell in the range of 3.5 to 15%. According to independent market analyst Ambarish Baliga, the measure will set the precedents for such taxes going ahead and is surely negative for refiners as well as explorers. A question which arises is that how will the industry get compensated when the prices are not remunerative? While he suggests investors avoid buying these stocks in the dip as the upside in profits are dented, Gaurang Shah has a contrarian view.
So I think the prime focus is that more and more domestic supply should come into the domestic market. I think it is basically to get rid of the inflationary pressure because of high energy prices. I would say Reliance, yes, because you named Reliance. ONGC is also on our buy recommendation. GAIL, in case if that is also down, then that is also in our buy recommendation. So these three exploration related companies, you can think of buying it. I'm talking about government exploration companies and government related oil marketing companies. Other than 20% dividend, I think there is no charm to look at, because those companies have not done anything. Given the fact that they spoke about the BPCL was one of the first ones on the divestment block, but again that has been put in cold storage if I'm not mistaken.
Last Friday's fall in benchmark indices brought them dangerously close to the bear zone territory. Let's go to Business Standard's Abdul Bakar to know key technical levels over the short to medium term.
The benchmark indices BSE Sensex and Nifty have tumbled close to 18% from their October highs. The current scenario indicates a pullback, and the question is whether this rally can be called a short-term rally or it should be named as a reversal. For Sensex, on the higher side the resistance comes to 54,400, and for the Nifty it comes to 16,300. Support for both the indices are placed at 50,900, and for the Nifty it is 15,180 levels. For Nifty Bank, the upper side resistance, it need to cross the level of 34,400 and it has a support of 32,200 levels. The most battered index among the major indices is Nifty IT index, which has tumbled 30% in recent times and has a resistance of 30,000 levels with a support of 27,000.
April-June quarter earnings season will begin this week, with TCS kickstarting the earnings season. The IT firm is set to report its Q1 FY23 results on Friday, July 8.
तुम इतना डर गए? अब क्या किया?
शेयर्स में ट्रेडिंग।
तुम्हें 5 पैसा नहीं पता?
ओए, अब तो सबको पता है। 5 पैसा पर मिलते हैं रिसर्च टूल्स, पोर्टफोलियो एनालिटिक्स और इन्वेस्टमेंट आइडियाज भी। डाउनलोड 5 पैसा नाउ।
अब तो सबको पता है, investing made easy and rewarding with 5 paisa. Investments in securities market are subject to market risks. Read all the related documents carefully before investing.
Ever wondered how difficult trading would have been before the advent of the internet? The internet, on its part, too has come a long way. Web 1.0, or the first generation of the World Wide Web, was like one-way traffic, a read-only format. Then came the current format called Web 2.0, in which we can read and communicate too. The upcoming Web 3.0, which is still in the making, boasts of decentralization as its bedrock. And now, former Twitter CEO Jack Dorsey has announced Web 5.0. Let us find out more about it.
even before we could fathom the intricacies of Web 3.0. Former Twitter CEO Jack Dorsey announced his plans to build Web 5.0. The goal, according to him, is to create an extra decentralized internet platform where users have control over their data and identity. But the idea seems similar to that of Web 3.0 and is centered around the same theme, that is decentralization. So what exactly is Web 5.0 and how will it be different from Web 3.0 and Web 2.0? Let us try to understand. Web 5.0, being developed by Jack Dorsey's Bitcoin business unit, TBD, is reportedly trying to solve all the problems related to identity and data in the current web system. It aims to give data ownership to users where they will control it. To understand the difference between Web 3.0 and 5.0, let us look at the evolution of the internet. The initial phase of Web or Web 1.0 was built around one-way communication, where users can only read the information on the web pages and cannot interact. The evolution of the internet has led to Web 2.0, which is the current web system that we all are using. It is dominated by social media platforms where users can interact, comment, share, and create content. But in the current web system, users generally have no control over the data and it is stored with third parties. There are also genuine concerns around how big tech companies such as Google and Facebook control most of the data and the chances of potential misuse. Ushering in a more decentralized internet, Web 3.0 is being built on multiple blockchain networks to reduce the need for intermediaries or eliminate threats of censorships and outages. In essence, it is designed to give control to users where the data is stored in multiple blockchains and thus being owned by users themselves. So how is Web 5.0 different from Web 3.0? Even though Web 3.0 and 5.0 more or less share the same vision, the technologies and protocols employed to build these platforms are different. Jack Dorsey says Web 3.0 is mainly based on multiple blockchain networks or single point of failure systems. He claims that Web 3.0 is more centralized than what is portrayed in the public discourse and is controlled by few venture capitalists. Web 5 developers are saying you don't need a blockchain for everything, and that they can build decentralized applications on well understood, distributed, centralized systems of computer science. Web 5.0 will have a series of decentralized apps and protocols. Instead of multiple blockchains, Web 5.0 developers are trying to leverage only Bitcoin and build everything on top of it. In Web 5.0, users will hold a digital wallet that securely manages their identity, data, and authorizations for external apps and connections. For instance, a user can use his or her wallet to log in to a new decentralized app. They may not need to repeatedly create fresh profiles and log into new applications, as Web 5.0 will aim to give users a decentralized identity, allowing them to seamlessly move from one app to another. User data, rather than getting stored with third-party products and services, will be controlled by users and only be exposed with their permission.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
Experts say that the decentralized platform may also lead to friction between the government and promoters of Web 5.0. That's all for today. For more news and analysis, please log on to businessstandard.com. We'll be back tomorrow with the next episode. Thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.